Howdy, Jacob here. Today we're looking at Dolby Laboratories in the electronic equipment, instruments, and components industry. 6.6 billion market cap on a 5.7 billion enterprise value. Founded in 1965, they create audio and imaging technologies that transform entertainment at the cinema and elsewhere. So the growth has been pretty lackluster, just under a billion to 1.3 billion in 2023. You're looking at 2 to 4% revenue growth year over year, but these gross margins and operating margins are still very impressive, although declining. So gross margin was almost 93% in 24. It is now 88%, still extraordinarily high, with an operating margin going from 29% down to 20%. They do pay a dividend. That dividend pays about 1.7% yield. Return on invested capital, still pretty solid, averaging high single digits, but it has been low double digits in the past. Income statement does show a good amount of R&D spend, over 20% of expense in R&D compared to their revenue. So that's a good amount of investing, taking money away from today to invest more into the future, to hopefully grow more efficient business, etc. So even with over 20% expense for R&D, they have massive 20% margins here. And share change down a little bit. Balance sheet has almost $1 billion, almost $900 million in cash-like products with no short-term debt, no long-term debt, 608 in total liabilities. So we're very comfortable with this balance sheet. We're feeling very safe about this investment. Cash flow statement shows extraordinary positive cash from operations and free cash flow, with cash from operations almost the same, but CapEx actually declining. So that's pretty interesting, with majority of their money going towards a dividend, share repurchases, a little bit to investments and acquisitions. So I think that is enough to have me make my assumptions here. I would say that for revenue growth, probably not going to be looking at too much greater than this. I think 4% makes me pretty comfortable. Maybe 5%, saying they invest 20% in the business for acquisition, reinvestment, and then let's do 40% for dividend and share repurchases. So that dividend of 112, they've increased that pretty solid in the past. Let's look at share repurchases first. So 1% is about 66 million, but their stock-based compensation is very high. So maybe actually 0% change for, or let's do 0.5% change down for share repurchases, and the dividend, let's grow at 5%. This is assuming roughly 40% dividend, 40% share repurchases, 20% acquisition and reinvestment. And for margins' sake, let's look at something like 20 and 22. Feeling good about that. Terminal PE, probably above market average here. 15% return. I think I'm comfortable with that. Their return on invested capital is good, but not great. Their growth is good, but not great. I think just in line with market looks reasonable to me. And we're saying it needs to fall 58% before we get the return we're looking for here. So this is not something I'd be digging into too quick, but numbers look pretty solid. So just not at the right price for me at this moment. Hope you enjoy the video. Thanks.